So we're having tech company after tech company miss on earnings, Google miss on earnings, Apple missed on earnings, Amazon missed on earnings, Microsoft's earnings were not the best in the world. All of those companies are signaling massive slowdown. They are signaling peak demand in 2021 and in 2022 after we had the stimulus. Now the stimulus is gone. The savings rate is lower than the 2008 financial crisis. And people are taking on credit card debt to actually buy, a lot of things. And again, this is what's happening in the market, but it wasn't a surprise to us and you guys, my subscribers, because I have been talking about it for months and months, and it's finally here that the earnings estimates are way too bullish for those companies, for the slowing environment, and they have to be revised lower. And the entire thesis is pretty much playing out in real time, yet the stock market's going up anyway on short squeezes and, FOMO. And again, it's possible that all of it was priced in, but I still believe this is not some type of a sustainable rally. But again, take a look at Google's earnings. They actually missed on search, they missed on YouTube ads, they missed on total services, they missed on the cloud, they missed on EPS, they missed on free cash flow, they pretty much missed on everything. And in this video, I'm going to revise my old thesis to determine if Google is a buy at those prices, or if I have to lower my price target again, or what is a good buying opportunity for Google for you to double your money in the next 3 to 5 years, because this is what I look for in my valuation model. I'm not interested in doing 20, 30, 40, 50% in 5 years. I want at least a double. And if I can't get a double on any investment, I'm not going to buy this specific investment. So I put in a price alert in my broker account, and then I get notified whenever it hits my price target. And I actually did a video before on Google when it was like $120, and I said why I don't own Google stock and when I will consider buying. And I said I would buy Google under $90 per share. Google did go under $90 per share, and I initiated a position pretty close to $85 per share. But now Google is around $103 per share. So we're going to take a look again and determine if it's a good buying opportunity or not. Now looking at the revenue, again, it slowed down massively. It was only up 1%. Year on year. On a constant currency basis, again, it's up 7%, a little bit better. And now the dollar is going down. And the second half of 2023 or in early 2024, Google should start getting currency gains instead of losses. Why? Because the dollar is going down. So if it keeps going down, they're going to experience currency gains. But again, they grew, in constant currency around 7%. A big slowdown from 33%, but that was, again, peak demand over there. And EPS has declined massively. And if we do the same things that I did with, Meta stock, and we just take the $1.05 of EPS, and then we just time it by 4 to annualize it. So if we try to estimate that Google maybe can earn around $1.05 for every quarter for the next 4 quarters of 2023, this is around $4.20 of EPS. We take the current share price of $103, we divide it by $4.20 of EPS, we get around 24.5 times earnings. Now, for 7% revenue growth and for declining EPS and, a pretty big slowdown, in my opinion, 24 times earnings looks a little bit expensive off the bat for Google. But we can't just use this number and determine Google is not a buy. We have to take a deeper look and then look into my valuation model. And this is where we get a clearer picture over the next 5 years. But just taking a quick look at Google, it does not look like it's a bargain at those prices, even though Google is one of my favorites among the big tech names. But looking a little bit deeper at their earnings report, their Google search and others, it's pretty much slowing down. The YouTube ads, which I've been pretty bearish on, I'm pretty bearish on the ad industry in general. I think it's going to slow down a lot in 2023 because we don't have the crypto ads we had before. We don't have the auto ads we had before. We don't have the housing ads we had before. And a lot of things around, housing and autos, which normally is bad in a recession. I believe the ad market could get hurt very, very much. And it's already playing out for Google and for Meta and for a couple of other companies, but most of the growth for their revenue pretty much came from Google Cloud. The biggest problem with Google Cloud is, yes, it's actually growing massively for Google, but it's not yet profitable. It's actually losing money. But again, looking at the trend of Google Cloud, it's actually losing less money over time, which is pretty encouraging. And if this can actually continue for Google, maybe one day it could become profitable. Although there's one ex-Google employee in my personal group, and he tell me, maybe Google Cloud will never become profitable. And I believe he knows a little bit more than myself in terms of the tech industry. But again, if this trend continue, it's pretty encouraging for Google. But again, the other bets are actually losing a little bit more money, and income from operations declined, which none of it is actually good for shareholders. But not only that, Google is actually trying to fire some employees, around 12,000, which is good. But they still expect to incur around 1.9 to 2.3 billion of unrealized charges and a couple of other things in the first quarter of 2023. So the first quarter of 2023 is likely going to be worse than the Q4, of 2022, which is not a good, trend in general for the ad market that's slowing very, very much. And it's likely going to slow even more in 2023. Now, Google has been taking advantage of this opportunity whenever the stock price went down for them to reduce their shares outstanding and buy back a lot of stocks, as they still have a massive cash position. And I believe this is the right thing to do in this environment. And I hope they lay off, a little bit more and then, have a pretty healthier margin for the company, because they really overhired, all those tech companies. So this is what Google is doing. And again, it wasn't the best earnings quarter in the world for Google. Now, taking a look at my valuation model, I put in 283 billion of revenue for 2022, which was the current revenue. I put in only 5% revenue growth for 2023. Again, why? Because the ad market is slowing down. We have a global recession. I mean, everything is slowing down. You can see the trend with all companies. So you can't expect Google to grow 15% next year. Although it's possible, but again, I just don't see it. And this is not something I want to bet on. So using a 5% revenue growth for 2023 and a sustainable 10% for the next 4 years for 2027, I believe this is pretty fair for the company, using a 25% net income margin, which is pretty much the same net income margin they have right now. This is around $108 billion of net income for 2027, using 18 times earnings. Again, people will say Google should be trading at 25 times earnings, not 18 times earnings. That could be the best case scenario. But after 2027, maybe Google cannot keep growing 7 to 10% every single year. Maybe the growth will moderate around 3 to 5% as it becomes a much bigger type of company. So you have to take those things into consideration. And I believe 18 times earnings is fair. Now, in this scenario, Google would be a $1.9 trillion market cap by 2027. Now it's around 1.2 trillion. That would be around 63% on the upside over the next 5 years, not factoring in any buybacks from the company, which is around a 10% compound annual growth for every single year for the next 5 years. Now, this is not bad at all, but based on my model, it actually shows that Google is not a buy. Now, if Google trades at 20 times earnings, 5 years from now, this is 81%, still a little bit better, but it's not 100%, which is why I continue to believe that Google is best to be bought below $90 per share. And again, some of you will say it will never get back to $90. But the way I'm seeing those earnings play out and the way I'm seeing the ad market play out, I believe Google could even go, pretty close to $80 per share again. And I believe anywhere under $90, and I prefer below $85 per share, as this is the price that's required to get it double. I think this is an amazing opportunity, to buy Google stock. Now, of course, if you're satisfied with 10 to 13% return, you could buy FOMO all in on Google right now. But for me, if I had to buy, Google and I didn't own any position, I would wait below $90 per share to get a fair value on the company and not overpay. I believe that could be a pretty good buying opportunity in Google. So this was my video for today. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another